What do you really know about your investments and your financial advisor? Gary Sinderbrand, a veteran advisor and founder of Better Path Training, has spent decades helping both financial advisors and their clients get it right when it matters most. Gary pulls back the curtain on the advisory world to reveal the truths, the gaps, and the opportunities that most people never hear about, but absolutely should. It's about more than money. It's about legacy, trust, and making sure the people you care about are in the right hands. Welcome to If the Public Only Knew. Now here's your host, Gary Sinderbrand.
Greetings, this is Gary Sinderbrand. If you're looking for some feel-good advice, rainbows and unicorns, a pep talk about what a wonderful career this is, you kind of came to the wrong place. Been at this for a very long time, and just off the bat, I'd like to tell you what you're going to hear on all these podcasts is what you need to know. Now, it may match what you want to know, but if it doesn't, keep an open mind, see where it goes. I've spent a lot of years as a financial advisor, not the glossy brochure version. I mean the real deal. I've trained probably over 10,000 financial advisors over the course of my career. And I've also watched clients do extraordinarily well and do some of the dumbest things I've ever seen. What I've tried to do is distill all of that into a series of podcasts, which I hope you'll tune into on a regular basis, where I'm trying to eliminate all the mistakes I made and what I learned, not just from my own book of business, but also from the thousands of FAs I had the privilege of working with over time. Let's start kind of right at the beginning. And I think it's kind of appropriate right now as this market tends to pull back as political winds begin to have an impact on what up until a short time ago seemed to be a pretty good economy. We'll get into the political stuff on another one, but let's just stay with some baseline things right now. And let's talk about the word that we see in every single document you'll ever put in front of a client. It's 4 letters. It does end with K, but it begins with an R, and it's risk. Most people, as they consider risk, always basically associate it with loss of capital, a bad trade, a bad idea, whatever is going to make them most comfortable within their own version of risk. The problem that we run into is if you ask them to define what risk actually is, most people are not going to get it right. Try it yourself. Give me 7 words to define risk. All right, don't cheat. The Webster's definition of risk is the possibility of something bad happening. Actually, it says the possibility of loss, damage, or injury. As a result of that, if you were to replace those words, those 7 words, in any new account document or any document you would ever put in front of a client, and they have to read multiple times, risk of loss, risk equals loss, damage, or injury, you're never going to get a client again. They're not going to sign. They're just not going to like it. Greetings and welcome to Financial Advisor Masterclass. This is Gary Sinderbrand, and I'm hopeful that over the course of these episodes, you'll pick up a thing or two. I have been a financial advisor basically my entire life. These days, I make my living helping other FAs avoid a lot of the idiotic mistakes I made early on, but also to give you the benefit of what I've learned from the thousands and thousands of other financial advisors I was lucky enough to interact with, primarily at Merrill Lynch, but also at other firms over the course of a 12 to 15-year period where peer-based training was the norm when we were at Merrill. If you're going to learn how to do it well, you want to learn from people that are doing it well, but also, even more importantly, from people that know how to explain it in plain language. And that's what I'm going to try and do on all of these podcasts. Let's start kind of right at the beginning. Because every single form I've ever seen a client fill out, whether they're filling out an initial client profile or you're going in and looking for some way to get them into a planning-based approach, the question is always posed what their view of risk happens to be. Now, I think this is it's kind of adorable when you think about it, because if you followed that up before you handed them the questionnaire so they could pick a category, you would very quickly realize that they can't define the word risk in probably less than 10 words because it only takes 7. Risk is the possibility of loss, damage, or injury. That's it. That's all it is. Now, people have different views toward risk. Some people have a very high tolerance for uncertainty. Some people want to know how everything is exactly going to work out. Let me give you an example. Client comes into your office. You've got a couple $1,000,000. They're interviewing various advisors. They tell you they have an extraordinarily low tolerance for risk. However, they're 10 years away from retirement. You understand what they're going to save, but they don't want any uncertainty in the portfolio at all, as in they hate the stock market. I've always found it kind of interesting to personify it with a word like hate, because the stock market doesn't really care what you think. It just is. It's like any other market out there. But somewhere along the line, somebody got a bad stock tip, and maybe it was them, maybe it was someone they knew. They lost all their money, yada, yada, yada. We've heard that story a lot. So you run all the numbers, you put everything together, you get a nice spiffy cash flow, and you look at it and you can come back and you can tell them that over the next 10 years, the way they would like to invest, they will not have any risk, none whatsoever. In fact, for the rest of their life, they'll have no risk because they're going to have a certainty. Based on what they're trying to accomplish, they will run out of money sometime in their mid-70s. No risk whatsoever. Where do you sign? That's happened to me more than once. So what do you do? Well, you can explain to them there's a number of things they can do. They can retire later, or they can spend less when they do, or they can save more right now. Now, let's assume none of those things really work. Well, that's a problem. On the other hand, if you had taken time to explain risk as a possibility, not a certainty, but as a possibility, and you took time to educate that client up front about how equities over time will outperform all other liquid investments, specifically bonds and cash. We just don't know when. Of course, for 1 year, it might be 50-50, flip a coin. 5 years, it probably gets up to 8 out of 10 times. At 10 years, I think it's 9 out of 10 times. You got that 15-year range, and equities are going to outperform basically 100% of the time. So what risk are they absorbing other than the risk of not looking to see what the value of their assets are? I would wager a lot of people right now, based upon what's happening in the markets since, let's call it the beginning of what's his name's term, are thinking they probably took too much risk. But those same people at the end of last year, as they watched their equity portfolios go up by probably 2 or 3 times their expected rate of return over a 4 or 5 year period, they all thought that was just couldn't be better. Isn't that great? Look how much money we're making. Look how smart we are. We're in the equity market. We've been around a little too long for this. So if you live through 08, or you live through 2000, or like me, you live through 87, you start to figure out real quick that allowing yourself to be subject to recency bias and confirmation bias and all this other nonsense that's fed to us 24/7 by algorithms that self-adjust is not the discipline we need to allow us to manage risk, which I'll call uncertainty or volatility, in a way that can get your clients from where they are, which I'll call point A, to where they want to be, which I'm going to refer to as point B. So let's think about it this way. I had a client come in, true story. Client was the senior litigation attorney for a major New York City law firm in securities law. So not the typical client that would come in. Him and his wife came in. They had survived barely the internet meltdown where they were kind of doing it themselves. And they interviewed a variety of advisors. I took them through what my discipline was. I took them through how I relied upon setting a financial goal that was sensitive to their needs, but also that I could sign on and say, I can get you there. If it was 12%, I wouldn't take the case. But it was something within, let's say that 6, 7, 8, 9% range, depended upon what might happen between when they start, point A, and ultimately what they need to have happen, we'll call that point B. I would make a determination. I would not take a client on board where I wasn't 100% confident in my skills to get them there. But that came with some caveats. If they hired me to achieve a particular result, they needed to listen when I wanted to make changes to the portfolio, despite what they thought might work better. And I told them, you'll get one pass, just one, and then you'll realize I was right. And then hopefully it'll be that way going forward. And essentially, I didn't rely on what my analysts were saying. I didn't rely on what prognosticators were telling me about the economy. What I relied upon was history and mathematics. Very simple. That led to a basic approach that I'll call dynamic rebalancing. So this client came in with $4 million. They wanted to reach $11 million by 2020. And this probably, I think I took them in somewhere around 2004, 2005. The rate of return they needed was somewhere around the 6 or 6.5% overall, which correlated initially to an asset allocation of about 50-50. I assumed equities were going to earn 8 over time. 50% of that is 4. Bonds make about 4. Half that is 2. 6.5% was what I was looking for. Now, what ended up happening as we were approaching the meltdown in 2008 was equities took off. They just had unbelievably high returns, 20%, 18%, 36%. to the point where the asset allocation, without me touching it, quickly became 65-35. Bonds were kind of sideways. Equities were going through the roof. And my return or my result was this. If they came in that day when it was 65-35 with nothing but cash, and they gave me the same targets, 11 million by 2020, would I put them in a 65-35 portfolio? And the answer to that was hell no. My job is not to guess the market or over allocate to an uncertain asset. My job is to get them where they want to be. When I did the math, they only needed from that point, because they literally had that much in value. After tax, I took them down to a 40% equity allocation, 50% bond allocation. By the way, I always use bond ladders. Figured out bond funds a long time ago. If you own them, you'll pick up a subsequent podcast and then you'll sell them because they aren't any good. As a result of that, I pushed back. I said, no, we want to ride the market a little bit. Argued with his wife, and they kind of stayed 65-35 until the market started coming off and bonds started going through the roof. They called, said they wanted to switch and follow my guidance now several months later. And I said, no, let's ride this cycle out. We will be okay. I think by the time it got back to about 60-40, I wanted to adjust it probably and invert it to 40-60. And that time they listened. Bottom line is this. They came through 2008 up 3%. Bond market absolutely bailed them out, as it did many of my other clients. In 2009, in March, the bond allocation had grown to about 75%, far surpassing my minimum equity hold of 35%. And basically, we went back into the market. They were terrified, as were a lot of people. Market bottomed in March of 2009. My comment to them, as everyone was frozen, was a year from now, we're either going to be pretty happy or we're going to be talking about ammunition and water. Thereby hangs the tale. By applying the consistent discipline that always pointed to a specified outcome, I had something to always fall back on. Think about your clients as they currently exist. And if you listen to the podcast on constructive doubt, what would happen if someone like me called them up and said, hey, when you look at your statements at the end of the month, can you attach them to a particular outcome? They're going to go, I just want to make money. Yeah, I get that a lot. No, look at your investments. Tell me how they tie in to what your needs are going to be down the line for you and your family. And basically, that's followed by kind of a look of, well, I trust my guy and we're doing really well. Basically, many times I've just wanted to say to them, listen, in about 2 to 3 weeks, you're going to become my client anyway. So why don't we just cut to the chase? Because clearly your guy's not doing his job and we just get it going right now. That was my number one prospecting question. Never used a value proposition. Amazing what you find out. Anyway, stay tuned. This one was all about risk and uncertainty, which most people, including financial advisors, get completely wrong. Once again, Gary Sinderbrand. Hope to see you on the next podcast. Take care.
Thanks for checking out If the Public Only Knew with Gary Sinderbrand. If you found today's episode helpful, be sure to follow the show and share it with another advisor, investor, or friend. For more on Gary, or to check out any links mentioned in the episode, head to the show notes. We'll see you next time.